Welcome to the Homeward Bound podcast by the Mortgage Guys, your ultimate guide to navigating home buying and mortgage lending. Whether you're searching for your first home or settling into your forever home, we're here to make the journey simple, clear, and exciting, helping you secure your dreams one home at a time.
All right, everybody, welcome back to the Homeward Bound podcast. I'm Dave, and this is Kyle, Dave Loescher, Kyle Torgeson, and we're going to be filming another episode here, bringing it to you with some important information that we think will help you in your mortgage financing and home buying process. Kind of exciting doing these again, isn't it, Kyle?
Yeah, I'd say that this is kind of my highlight sometimes, just to be able to break away, talk about the do's and don'ts and things of mortgage. And, if we can get a little bit of information out there for our clients, potential home buyers down the road, they're better off, we're better off.
That's true. And I sit there, we talked about this over the last week. We thought a little bit about these first-time home buyers, because you mentioned last time that, one of your first or your favorite things to type of client to work with is a first-time home buyer. And as we visit with them, they're kind of unsure about where to start, where to begin. And so we want to talk a little bit about some terminology today that is very important in the home buying and home financing process. You may have even heard of this before, and maybe they haven't. And it's going to be that pre-qualification versus pre-approval process. How often do you deal with that, Kyle, in your day-to-day business?
Day-to-day, every day. I'd say that that's probably the number one question that I run into people at the supermarket or at the gym is, I never bought a home before. Mm-hmm. And where the market has been for the last few years, there's a pent-up demand. There's a lot of first-time home buyers that have really been on the fence, a little bit timid about jumping in, but they want to now. And so they're coming out of the woodwork. They're saying, hey, I know you do mortgages. How do I buy a house? What should I be doing? What should I be looking for? And so this conversation happens daily.
Yeah. And really for you home buyers out there that might be listening to us today or watching our YouTube podcast here, you may be directed to get a pre-approval, and it may be directed to you by your agent, but however, maybe you just heard that it's something you need to get. And whether an agent sends you our way or you reach out to us and we're working with you, or whatever lender it is you're going to go work with, it's so important, we can't stress. Because, if you're going to go buy something, you go shopping, you want to make sure you have money in your bank account before you go buying something, whether going to the mall, the grocery store, whatever it might be. I guess I just dated myself saying the mall. Those kind of went out a while ago. So anyway, but you kind of want to make sure you have the funds before you go try to make the purchase, right? And it's kind of the same if you're going to buy a car. You want to make sure you have that financing in place if you don't have cash to buy. And then with a mortgage, even more so. You want to make sure that you have what it takes to be able to pull the trigger on that.
Yeah.
So there's a few stages to this, or a few steps to this that we want to kind of clarify. Now, aside from the most important thing as a buyer that they can do in this process of this journey of buying a home is, first and foremost, get a good agent. I can't stress enough, Kyle, I think about this, and we know the differences between a client that comes to us that has let's call it a recreational real estate agent versus a professional real estate agent. I think that's the most important thing they can do is have a good agent. Would you agree?
Yeah, the agents that really do maybe 1 transaction to 5 transactions a year, they forget a lot of things that are really, really important. We have a lot of great agents in the area. Love working with them. But yeah, there's the agent that maybe got their license because things were booming a couple of years ago, and they keep it up. And honestly, not to stereotype all of them, but some of them just don't remember how to fill in a contract. Mm-hmm. They don't know that we need a contract. They don't need they don't know that the title company needs a contract. And so you and I both have had experiences where those agents put a deal together and then a couple of weeks down the road they say, hey, oh, by the way, Dave, I put these guys under contract. Yeah, I forgot to give you the contract, but hey, our settlement deadline is in 13 days. Yeah. It can get ugly real fast. So,
and that's the type of stuff we do see, unfortunately, with those recreational type agents, or maybe sometimes a mistake can be made. But next to the most important thing about getting a good agent is getting pre-qualified. again, back to what we were talking about a minute ago, making sure you have the money now, or the financing in order. You're going to hear a lot about it in the industry, and they talk about pre-qualified. What does it mean? And a pre-qualification is basically nothing more than getting your information, usually in the form of an online or an in-person application, crunching some numbers, maybe just doing no more than pulling your credit report and seeing, okay, this looks like, based on what you said, that we can provide financing for you up to this amount.
Yeah.
It's really, and then we print a letter, and for years in our industry, if you remember, pre-qualification is really all that people did.
Mm-hmm.
And people went and put homes under contract, and then they find out in the 11th hour it falls apart, and that's not a good thing. And then the next level is what a lot of people hang their hat on, which is a pre-approval. And I'll just say real fast, a pre-approval takes it just to the next level. Maybe us as loan officers, we got some pay stubs, and we said, okay, you really do make that. Oh, wow, you do have $50,000 in your bank account. Okay, you're good. But we are not underwriters, are we?
No, you're right. And so, I mean, it's reassuring when we take an application and they bring a pay stub and we say, oh, you really are employed. Mm-hmm. That's fantastic, because up until that point, really, it's word of mouth. It's a stated income situation. And so going to that next level, where they bring in a pay stub where we can say, oh, you do really work for X, Y, and Z company. That's fantastic.
Yeah.
We manually calculate that income. We plug it in. Sometimes we find that they've understated or overstated their income at that point, and so we can adjust, but it's better.
Yeah, and it is.
It's not the best.
It's definitely better. A pre-approval is better than pre-qualification. And what I really like about what we do here, Kyle, and you and I talk about this a lot, is we have this thing that we call our accelerate approval. I think we talked it in that last episode, talked about it as well.
Briefly.
And that accelerate process, it's kind of like a pre-approval turned approval, or a pre-approval on steroids, I like to call it. And why don't you go ahead and expand on that a little bit and talk about it? There's
one thing that I really have enjoyed working with Premier Mortgage Resources is this is a standard. A lot of companies will offer this as a one-off not sales gimmick. It's not the right word, but something they do, just not a lot of it. They're not built for it. Our teams are incredibly built for this, and it's a standard, but like you said, it's on steroids pretty much. So we take that pre-qualification, and we issue that pre-qualification initially to the buyer. Mm-hmm. But then we say, hey, buyer, we're not quite done. We would really like to get you approved for your loan. Not just pre-approved, and I know we don't have an address that you're buying yet. While you're shopping, let's not waste time. And so what that's going to be is bring us in these few things, and we'll actually have these items underwritten and reviewed and your file updated, and we will issue you a full-blown approval based on this. Oh, yeah, while you're shopping for your home. So what does that do? Our sellers in the area are very familiar with a pre-qualification. They're very familiar with a pre-approval. What they're not familiar with is an approval letter, mm-hmm. Which is, again, like the next step. And it says very plainly on that letter, this loan is approved, income has been reviewed, assets have been reviewed, or your down payment source, and credit has been reviewed. And so really the only thing we're missing is what house are you buying, and does it value for what we need it to value? The power of being able to check off 3 of the 4 boxes while they're shopping for a home does a lot of things. It makes you as a consumer and a buyer way more happy, because that 11th hour nightmare is not coming around. Yep. But it also makes the seller happy because they know that 11th hour nightmare is not coming around.
Yeah.
And so it's incredibly powerful, and a lot of sellers will look at these in comparison to like a cash offer, because it's just about as secure.
Yeah, it really is. And that's what I love about the accelerate approval is that, in the onset, our borrowers, they fill out an application, and you probably get it just like I do, where they fill out the application and they say, hey, all of a sudden you just immediately upon submission, we say, please get us this, 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 and this. And we're asking for pay stubs. We're asking for bank statement. We're asking for the things that we need to be able to take this all the way through to that approval you just talked about. So it's no longer just a pre-qualification or a pre-approval. We ask for those things. Just do it, get it in, because once we have that, their offer is going to be leaps and bounds ahead of the other just pre-qualifications that are letters that are sitting there. And that seller, with a little bit of education, they should know that this one is a little bit more valid. So
yeah. And the other benefit that a approval letter does, because our borrowers have been working and getting us information, now their loan's fully approved. Man, that shortens that time frame for closings down so fast, where we don't have to, say, hey, you got an offer accepted. Now bring us X, Y, and Z. We've already covered those things. It's in the past. It's done. We've already checked those boxes. We are just simply saying, okay, let's get the appraisal ordered. That'll be here in 10 days. We can close. Yeah, let's close fast. Let's get it done.
And that's super valuable to the agents that might be listening today, or you buyers out there that might be listening, because your agent is going to want this. Your agent is going to want for you to have already had things checked off, and not just, we'll get to that down the road, but it is checked off, because that's one less thing that could blow up down the road in the 11th hour. Now, so anyway, that we're happy to tell you guys more if it's something you guys want to reach out or comment at the bottom of the podcast, especially if you're on YouTube. It's a great place to leave a comment, and we'll reach out. We will not leave you hanging. But once we're underway, let's just say we've got that accelerated approval out there, Kyle. We're getting going. The buyers now have something underway or in the process, or even maybe they don't quite have something underway. There are definitely some rules. There are like our do's and our don'ts, right? Some things we want them to do and things that we certainly want them to avoid during this process.
Yeah.
So let's talk a little bit about that, if you don't mind.
Yeah, you bet. And so the first one on our do's for our home buyers, and this is related primarily towards, obtaining a mortgage, what you should do and what definitely you should not do. The first one is definitely get pre-approved. Just like we were talking, this can help in your negotiating strategies. It makes it secure for you to know what you can afford, because your lender's going to tell you, on the upper level or end of things, you should be here or lower, which also helps in our negotiating power for a home. Because if you're trying to buy a $400,000 home and you have a pre-approval letter, or in this case, an accelerated approval letter that says, hey, John Smith is approved up to $400,000, but you're putting in an offer on a $350,000 home and you're trying to edge that price down a little more still, coming to the table with a letter that says you're pre-qualified or pre-approved or approved up to $400,000 does not give you that edge.
Yeah.
And so it's something that's really unique and pretty powerful is we can kick out pre-approval letters or approval letters pretty darn fast from really anywhere on our phones. Yeah. And so a lot of our clients will simply reach out, it's usually a Saturday, and say, hey, I'm putting an offer on this property. I need my new letter to say this.
Yeah.
And so we just simply kick those letters out, email them out within a few minutes, and they have that negotiating power. And again, a new and updated letter that tells them that they're ready to roll.
Yeah, I want to say real fast.
Yeah.
That leverage is so important. You don't want to show all your cards, definitely. I mean, if you're going to go, think about it, I'll simplify it a little bit. If you're going to go look at a vehicle and the person wants, $3,000 for that used truck, and all of a sudden, and that's what they want. I mean, you're not going to want to sit there and just show them what's in your wallet first, because you've lost leverage at that point. They know what you're capable of or what you would do. And this isn't a dishonest thing we're trying to say. It's just there's no need to give any more information than you need to give when it comes to negotiating, and that's just part of making a deal.
Yeah. Yep. The second thing we want you to consider, a new home buyer, is keep an idea of what that monthly payment looks like. Really take into consideration what you want it to be also, and maybe back into what that loan looks like or that purchase price looks like at that point. But talk to a mortgage professional, have them calculate that. A lot of times people forget that in those mortgage payments, there are other items like escrow taxes, insurance, sometimes mortgage insurance, and that takes the principal and interest payment and adds on to that. And so I was talking to a client today and they're like, well, no, our payment should be $1,900 a month. I'm like, that's true. And it is. But when we get your insurance, taxes, all that stuff, it takes up to about $2,300 a month. Yeah. And so talking to a mortgage professional about what those are and remembering that those are in there is truly important.
Yeah, and it is, especially when we're dealing with people that might be buying that first time home, and maybe they're used to paying rent of $800, maybe it's $1,000, maybe they were those lucky people that had low rent, and then all of a sudden they want to buy that first home, and they're buying a decent sized home.
Yeah,
and the payments, just with current sales prices and the other things that go along with it, with insurance and those escrows he talked about, to have a payment that's $2,500 is not abnormal. It's common now.
Right now it is.
It's for a first-time home buyer. So with that being the case, you don't want that to be something they're shell-shocked with down the road. You want them to be able to know that from the onset so that they are ready to go. I mean, to have a deal come apart because they just have payment shock down the road that's not good.
Yeah. And one thing that can kind of help with that payment shock is getting a better rate. Rates are really tied to your credit score. And so, I mean, Dave, we have some programs that go down to 580, even less. 580 is terrible, unfortunately. I wish.
Sorry if you're somebody out there with 580. We're not calling you terrible. It's
we're just saying you can get a much better interest rate if you're 830. And so there's a wild swing in rate and payment, of course, if you have better interest rate. And so or better score, so we can get you better interest rate.
Absolutely.
The next thing you're going to look at is talk to a good lender. Honestly, the cheapest lender is not the best lender. Typically, you're paying for service at the same time as anything, and so rate shopping is definitely important. But at the same time, there's no substitution for good service and knowing that you're going to be taken care of and closing on time. Yeah. I've talked to a lot of people that said, "Man, I took the cheapest interest rate and took us 45 days to close. We were worried that we weren't going to close. It was just terrible." And so, definitely make sure you find someone that knows what they're doing and can offer you the best service possible. I think we do a good job in our office here.
I do too, and I think there's a reason that these agents out there, these real estate agents, are really referring their buyers to people that they know and trust. It's people that they've had a good history with, a good track record, somebody that is able to get that thing across the finish line, someone that is communicative, somebody that's proactive, someone that's not kicking a can down the road and hiding from their phone. It's somebody that's answering when they need to answer. They're making sure the thing is coming together well, and that's just what sets a good lender apart. And I think that is way more important to an agent that's involved with this and the buyer as well, than somebody that just simply is offering the lowest rate. The lowest rate can come back to bite you.
Yeah, and typically the lowest rate is maybe an eighth of a point, 0.0125 better.
Yeah.
Which doesn't translate to a material benefit. It really, really doesn't. And so find someone that you know is going to take really good care of you. It'll make a big difference in your life.
Absolutely.
Next thing is do plan on taking some cash to the table, meaning that either with your down payment, your fees that you have for creating the loan, you should not, even if they have a 100% financing program, that's 100% financing of the purchase, not necessarily of any of the fees.
Mm-hmm.
And so sometimes the seller will help compensate and take care of some of those as well, but don't plan on it. Definitely plan on having some cash reserves so that when that comes up, you can take care of it.
Yeah, because there's been times in the past where there are some programs and some things where people were able to, like you said, the seller's willing to make a contribution that's significant and still, and what that does is it makes it so they could possibly walk into a home without having any money out of their pocket, which is very much the exception, not the norm.
Yeah,
when it comes to a transaction. Good point.
We've been part of both of those. The ones where we're actually giving cash back at the table, and some, of course, where we're saying, okay, your cash to close is this amount. This is how you get it to the title company. In that same train of thought, ask about closing costs. Closing costs are always typical. They're third-party costs a lot of the times for your appraisal, your title reports and searches, your closing at the title company, even your lender. Aside from that, people can choose to buy down the rate, and that's called buying points or discount point, which can add into those. And so you can never ask too many questions as a buyer. We love it when our clients ask us more questions because it means that they're paying attention. It means that they're getting involved, and it makes our life easier at the closing table when they've asked those questions ahead of time.
And just before we came in here in the studio to film this or shoot this podcast, I was working with a buyer right now who's getting I just pre-qualified him today. Gave him pre-approval. We're right now, he just uploaded his stuff for that accelerated approval we talked about. And one of the things he said in there is, he said, are there any programs or anything that I can do? Because I gave him an idea what the payment would be on this bigger home, this more expensive home that he wants to get. This is their second home. And I said there really isn't a significant a program out there that's going to give you significant savings per se. Those are more first-time home buyer things that have, down payment assistance or something like that. But for somebody like him who's selling a home and he's going to have $100,000 down, really the conventional loan is almost always the best program if you're in this situation. He's a person that has almost 800 credit. He's got, solid borrow. So I told him about what you just mentioned. Sellers can contribute, and we can do temporary buy downs. And these temporary rate buy downs are so valuable, whether it's a 1 year, 2 year, or 3 year temp buy down, because, we're in this time of assuming interest rates continue to go down. And I told him, if your seller's willing to
wood right now,
knock on some of this wood. If your seller's willing to contribute, then while we're in this, period where we think the rates are going to go down over the next 2 years, why not get your rate anywhere from, 2 or 3% lower than current market rate for the first year? And then, each year it's just a little bit different. But anyway, the point is they can save a significant amount in those first 2 to 3 years.
Yeah.
If they do one of those types of programs. And that's a little bit more complicated, but it's simple for us. It's maybe more complicated to the listener to think right now, how does that work?
Yeah.
And we're happy to do that.
Yeah, I agree. And so those are the do's. Now we're going to talk about the don'ts. These are very important. I hope everybody that's buying a home, even if it's not their first rodeo, we definitely like it when our clients pay attention to these. But first and foremost, debt to income ratio. That's is an important thing. One of the things that we look at immediately and our underwriters look at immediately. It's one of those few things that can make or break a deal real fast. But how that's calculated is you take your monthly debt payments, not the amounts, but the actual payments that you make, and it's the minimum payments. And so if you got a credit card that has a minimum payment due of $25 a month, but you normally pay $200 a month, no, it's just $25 a month. And so this is how you calculate your own debt to income ratio, but get those minimum payments for your mortgage and those minimum payments that you'd have for your car, your credit card, whatever it is, and then divide that by your monthly income, but your monthly income before taxes. Mm-hmm. And so that ratio is going to be something that we look at immediately. And Dave, what's kind of the typical debt to income that we like to see, at or under?
I could say it varies, but more often than not, we shoot for that 48%. I always like to say 45 to 50, depending on the program. If someone's got good credit, if we know they're going FHA, we can get them to 52, 55 even in some cases. But really, if we can, for people to do their own calculation, let's just say aim for 50%, talk to us if it's at that number.
Yeah, they're definitely doable. But what that means is out of 50 cents of every dollar that you earn is going towards debt.
Mm-hmm.
And so that can be significant because we don't look at their taxes. We don't look at any charitable contributions or anything else that they donate to. Mm-hmm. And so that can create an issue for them financially if they're too over leveraged, which leads to my next don't, which is don't max out your loan amount. I wish I could make a song about that, but don't max out your loan amount. I don't know how that goes, but essentially, if we're talking about the same scenario we had, this person is pre-qualified up to $400,000, mm-hmm. but they're at that 50% mark.
Mm-hmm. I just had some, not to steal the thunder here, but the same borrower, he said, okay, so what am I pre-qualified to? He, in his application, was looking at a loan of about $315,000. I said, look, that's easy. Based on, because we have his information. Based on that, we can approve you to much more. And in a phrase I've used along the years for this is, I can give you enough rope to hang yourself if you want me to. And what I mean by that is, people that have great credit and people that have a good paying job and they keep their debt low, yeah, we can give them an approval up to an amount that's probably far higher than what they're comfortable with. And with this guy's situation, I said, okay, your payment's going to be about $2,200 if you do the $315,000 that you applied for. And I said, however, you want to know how high I can go? I can give you a loan over $500,000. Well, what's the payment going to be on that? And then I told him what that payment would be, and he goes, I'm liking that $315,000 I applied for. So, in so many cases on this, I think it's important for these people to know it's not. You should ask in our process when they're working with us just to see, because in some cases, can give them enough rope to hang themselves if they want.
Well, I mean, and what that translates to is, you bought your home, but you're sure eating a lot of ramen and a lot of PB&J.
House poor.
You're house poor at that point. And so, can we get it approved? For sure. Should you want it to be approved? That's up to you. But at the same time, you want to be comfortable. You want to be able to live your life and enjoy you and your family. So, don't max out your loan amount. The next one, it's one of my favorites too. Don't apply for any new credit cards during the mortgage process or just before. So we run into this a lot where we do a credit check and like, oh, it looks like you had a credit inquiry. Yeah, I was going through the line at Home Depot and they said I could get 10% off on my $100 purchase if I got a new credit card.
Well, they're a new homeowner. They're already looking at stuff at Home
They're
Depot.
looking at Home Depot. They're like, yeah, I'll 10%. That's awesome. What is that? $100 to $10? That's a great deal. But what that causes us to do is, we have to get that new statement, and which means that we have to wait for Home Depot or whoever services Home Depot credit cards to send out a new statement, which means that we have to be delayed because of that. And it could have hurt their credit too before we pulled it because they had a new inquiry. Mm-hmm. And so if you're really serious about looking at a mortgage down the road, do that first.
Yeah,
close on that home first. Get your 10% off after you're done.
Yep. And I think it's important because a lot of people think, well, we're good. And they think we're not going to see it sometimes. And I think it's important we cover this right now for these prospective buyers. They know that you're not good until we've closed that loan, until you've gone to title, closed that mortgage, then go do what you want to do with Home Depot or whatever it might be, because during the loan process, we still have to, and we will get notified of any new inquiries on their credit. They have to understand that we will see that, and then we're going to ask about it, and then we have to have clarification of it, and it can actually damage a deal.
Yeah, it sure can. It could even decline a deal, which leads to the next one that kind of follows suit with the first that we talked about here is, no new or big purchases. Don't go buy a new car. We talked about that in last episode. Yeah, that can really make a big difference. And so, if you want to get a new car, but you're tight on your debt to income, like we talked about, yeah, absolutely do it. But not while you're in the mortgage process.
Yeah.
Close on the home, make sure that records, maybe wait 2 days and go get your new car. Things happen. You need a new car sometimes, but
a lot of people during the home buying process, that's when they make some sacrifices, right? That's when they might sell a car, get rid of some debt, unload some things so that they can look better for the financing, get the ratios in order. There's a time and a place for everything. During the mortgage process is not when you want to go buy that boat, buy that RV.
Yeah. The next one is don't forget to lock in your interest rate. Interest rates, we were talking just before this, we were looking at the market trend today. It is full on a roller coaster. It is up, it's down, it's left, it's right. And that's pretty typical, unfortunately. We look at it every day like, hey, it was good. Oh, no, it's not. And, oh, hey, it's good again. And anyway, it's an emotional roller coaster at the same time. But, the key thing with locking in interest rate is does this interest rate look good to you? Is it something you can live with? If it is, and you can, and you like it, lock it. Is it going to go up or down after you lock? Yeah, it could. We talk about this quite a bit. But buying or locking your rate is like buying. It's like buying in the stock market.
Yep.
You're buying an Apple stock, something like that. And essentially, when you buy it, you own it. I had a client this morning say, "Hey, if we locked our rate last week, but if it goes down, we can obviously get that lower interest rate too." And I said, well, locking your rate is awesome. It definitely protects you from it going up. So congratulations. But it does mean that if rates get better, we're locked in.
Yeah.
And with this particular deal, we're closing next week. And so it doesn't really make sense to go all over the place. But other than that, we can't relock. It's prohibited.
Yeah, and it's definitely that process of the lock. I mean, our job is to inform them what the market looks like, what are rates at today, and then they always ask that question, well, what are they going to be next week? And our standard answer on that one is our crystal balls they broke. My crystal ball that's in my desk has been broken for years. I don't know what the future holds. We can speculate all we want, but where the rubber meets the road is it is what it is that particular day. And if it's good enough that they feel good about that rate, lock it in and don't look back, because you're dealing with the loan process is anywhere from 2 weeks to 4 weeks in time, sometimes 45 days, depending on the transaction. That's a short period of time. It's not the end of the world. We can look at a refinance down the road to really get an improvement on the rate.
Yeah, I mean, honestly, our borrowers that are locked, they're getting ready to close, they should be quite excited that rates are getting better. Because if it all holds true that 4 to 6 months to a year, rates are going to improve, they may not start to wait until you're closed with your loan until they start to do that. But you can always refinance and take advantage of those rates, and we hope that rates improve, and I really believe they will.
Yeah, and you said it earlier. This market is right now very, I can say unique. To us, it doesn't feel so unique, but it does definitely feel wild. To others, it would be very unique. We are dealing with things from, a change in our administration in our country. We also have the talk of tariffs, and there's so many things that go into this, and we're not going to go into that right now, but there's so many external forces that move interest rates. And I will say, the goal is on our next episode. So here's a little teaser I'm going to drop out there. Our next episode, we're going to have our head of secondary, who's the person that sets our rates for that day. He's going to be in this call with us. We're going to do a podcast on that. It's going to talk about what moves the needle on interest rates. And I'm excited to tell people, because when they hear the Fed dropped the rate, and we get all those phone calls, hey, the rate's better. And it's the Fed rate and prime rate are different than mortgage rates. And I can't wait to dive in to kind of just do an education from the 2,000-foot level on exactly what moves interest rates and mortgages. So I'm excited about that.
That'll be good. The next one that I want to talk about is don't rely on online calculators, and don't rely on posted interest rates on the internet, because a lot of those are bait and switch. And so, for calculating a mortgage, there definitely are some good ways to do that. A good financial calculator will help you figure out what your principal and interest will be. It won't wrap in those escrow taxes, insurance, like we talked about before. But really, talk to a mortgage professional. Call them up and say, hey, what is this going to look like? This is my scenario. We can have the ability to even pull up interest rates for people. Did that for a couple of people today. They were just curious. And so without an application, giving me an idea of what their credit looks like, what their purchase price is, I was able to calculate, this is what your rate is going to be. This is what your payment's going to be. And honestly, they were going online and saying, man, this is way better than it was showing online. And this is great that you're talking to me about my questions. And so online stuff can be good, but quite frankly, don't rely on it, because it could be persuading other ways. Yeah. If that makes sense.
And one thing I'd add to that is, the value of using a local lender is, somebody wants to get an idea what their payment's going to be. We can quote them. I mean, when you talk about principal and interest and interest rate, now we're talking mathematics. That's all that is. But what a local lender can do for you is we know what our market here has for an average of homeowners insurance. We know what their credit scores look like. We know about what insurance agents are going to quote them for that. So we can estimate that real tight. And we also have the ability to go into county records on a particular home they might be buying and pull up what that property tax is. So we're not just spitballing something. We're going to be giving that person, because of our local advantage, we're going to give them not just the mathematics side, but we're going to give them that escrow side to really come in with a very, very accurate estimated payment. And I think that just, is a testament to why they need to go with local lenders.
Yeah, and you also get the power of, what if I improved my credit to this, or what if I put more down, or what if I did this or that? Those online tools are great, high level, but getting into some of these what ifs, where you want accurate answers rather quickly, talk to your local lender.
Yeah.
I mean, we do this for people all day long. But my last don't is don't panic if things get a little bit complicated. Meaning that if our processor says, hey, Susan, it looks like, because of the financial statement or the bank statement you provided, it gives us reason to request this or that. Some new questions come up. It's normal. Don't panic. You could even call us and then say, now, why do you need this exactly? Tell me what the why is. We'll calmly and efficiently instruct you on why that information is needed. And honestly, buying a home is complicated. We try to minimize that complication, but at the same time, sometimes things just come up. It's not an exception. It's rather normal. But sometimes getting some extra guidance of what is needed there can help calm a lot of fears. I'm sure you've had plenty of people that say, they asked me for another bank statement. Well, why is that? We're like, oh, yeah, because another month went by.
It doesn't mean that we don't believe in what you've given us. That's
right.
Not it. It's not. And
credibility is not tarnished.
Yeah, exactly. I've had people that have actually asked, when I've asked for some of the simple things too, and we want them to ask. We want to clarify. That's our job. But the simple things like, I need a copy of your driver's license. Yeah. Why do you need that? I'm not speeding. You don't care if how I drive. Well, there's something out there called a Patriot. We have to prove you're who you say you are, A. And then we also have to ask for, several things that are supporting documentation that are just to give us as a lender, put us at ease on certain things. We're not going to get out of line, but we're happy to explain it. I think that is important that you brought that up, Kyle.
Okay. Well, that's our do's and don'ts. I mean, there's a lot of good things in here that I completely agree with. The things that you want to do is get information and take care of your finances.
Yeah.
I've talked to a lot of borrowers that just simply say, I make sure I pay my bills on time. And quite frankly, that's the biggest thing you could do. Because if you have good credit, that opens up a lot of doors. If you have subpar credit, really it makes it so we have less products to work with that are usually a little more expensive too.
Yeah, less options for sure. I think the takeaway from this particular episode today is that it's not as difficult, challenging, and complicated. And what I mean by it, meaning the whole process, from the application to the initial discussion, the application to the pre-approval, and these do's and don'ts, they'll help guide people to know this process doesn't have to be stressful. It can actually be enjoyable.
Yeah.
Especially in the fun of buying a new home can actually not be tarnished by a miserable lending experience. We can actually make this so that we're ahead of the curve. We're proactively telling them the information they need to know as we need it. We're never behind the eight ball, and that's actually very, very valuable for them. It's all about, just like any service-based business out there, and we're no different. We're a financial service, but any service-based business, it's all about the customer X, the customer experience, the client experience, and that's what we're here for. We're here to help them with their experience, to have less speed bumps and circumvent those things, so that this process goes through fast.
Yep. One of the biggest compliments I've gotten in was this morning at a closing. And as a real estate agent that's been doing real estate for quite a while, just moved to Utah, going to get their real estate agency or a license here. And at the closing table, she said, this was probably one of the more enjoyable experiences I've ever had. I said, you're welcome.
And that goes from the client to the agent experience. It's all an experience. So anyway, that's what we're trying to do here. And thanks, Kyle. These are always fun to be able to go back and forth on this. And I think it's important that we do say, those of you that might be listening to this in audio land, we appreciate you. Those of you that may be looking at this on YouTube, please, if you haven't already, subscribe, hit like on there. Please also comment if they'll jump on there and comment and tell us some things that they want to, any questions related to this or anything you want to hear. We're all about that. We like interaction. So we appreciate it. And again, future episode is going to be fun when we talk about interest rates and what that means, because a mortgage interest rate is not just A plus B equals C. It's a little bit more confusing.
Pulling back the curtain.
Yeah. We're going to open that curtain, let you guys see it. So anyway, thank you guys. We'll talk to you next time.
Yeah.
Peace.